Market news now. Beijing announced it will scrap COVID testing requirements for most public venues in what is seen as an accelerated move towards the exit of COVID-zero policies. But the possibility of new tariffs on Chinese steel and aluminum by the US and European Union may weigh on sentiment. The JSE locally will remove Penny Cap Nutritional Holdings as a listed company from the bourse later this month for failing to meet its listing requirements as the company fights not to be liquidated. The company was first suspended from trading in May last year. Meanwhile, in a pre-close investor update, Nedbank says its financial performance in the first 10 months of the year has been robust as higher interest rates boosted earnings from credit extension, while also flagging healthy capital levels that should support ongoing dividend payments to shareholders. The group's full-year results are expected to be released on or about March 7th next year. To talk to us about the latest when it comes to the markets, we are joined by Martin Smith from Anchor Capital. Martin, thank you so much for your time. I mean, you look at the hopes of China continuing to reopen, and then you have yesterday's U.S. services sector figures coming out remaining strong. How are you assessing market sentiment globally right now?
So I think this is one of a few things that are still kind of overhanging the markets and affecting it, but definitely positive. And you've seen that with the way that specifically tech stocks and resource stocks have reacted to it. You've obviously seen us pass and process in our own market. China makes up a very big part of global demand. So that'll be quite positive, specifically on the back of recession talks in Europe and the States. So it'll be a nice boost to kind of global economic activity and just sentiment in itself. So I think largely positive. Noises have been coming out for a little while. You've also seen the Chinese government stimulate the property side of their economy as well. So you've got that as well as the reopening. So very positive, and hopefully we see a full reopening in the coming weeks and months.
So when you have global, markets that are having, positive sentiment moving through, how are you looking at the local market sentiment? Because last week, Thursday, markets were in turmoil dealing with the Section 89 Phala report. And it seems last night that President Cyril Ramaphosa gained a lifeline. The local market sentiment right now, given everything we know?
So I think, last week was the markets sold off quite aggressively across bonds, currency and equity side of things on the back of that report. Again, the market hates uncertainty, and I think no one knew what was going to happen, how things were going to happen, were there going to be policy changes, who would be coming in. But like you said, you had the NEC meeting on Friday last week, and it seems like for now the market's pricing in that President Cyril Ramaphosa will stay. Obviously, I think there's a parliamentary debate next week, Tuesday. Again, I'm not a political analyst, but all things are pointing towards a bit more positivity, a bit more certainty, which again, the market likes. And you've seen the market, bond market and currency all recover pretty much all the way back to where they were in the last few sessions.
It's December 6th, so I think we can safely say we've kicked into the festive season, mood. How are you assessing SA retailers ahead of the festive season, especially when you look at some of the low-cost, consumer stocks?
I think it's going to be very interesting to see how they do. I think it's been well flagged that the SA consumer is constrained at the moment. You obviously had interest rates increasing a couple of weeks ago, and we've probably got another 75 basis points to 1% in the coming kind of MPC meeting. So the consumer is under pressure. We've got some macro headwinds in South Africa. So it'll be interesting to see how the consumer does during this festive season. We have updates from these retailers usually in January. So I think that'll be quite an interesting read through to see how we're doing. Another thing that's also to consider is that a lot of these retailers have spoken about increased levels of inventory. So maybe if the volumes don't come through, you might see discounted sales across the board, which obviously isn't great for them. So again, quite interesting, but definitely some headwinds for those companies.
Let's move things stateside. What would you say is a key takeaway for you when you look at the S&P's performance, at least over the past 2 months?
So I think obviously you've seen quite a nice bounce out of offshore markets in the last 2 months. But I think if I had to look at it and try and analyze it, I think it speaks to the fact that people were, or investors were, overly pessimistic about the prospects in recession and I think the fact of the matter is there've been a few glimmer of hopes from a CPI perspective, from an interest rate perspective. Earnings in the last quarter weren't bad either from a US perspective. So I think it spoke to the fact that people were very, very pessimistic, and just those kind of not bad numbers coming through have pushed up sentiment, and obviously the market has followed course.
So, I mean, how do you position your portfolio in an environment like this? So let's start off locally before we go, stateside. In an environment that we've just described with so many things, the macro headwinds, locally, how do you position a portfolio? What are you guys liking as anchor?
So I think the SA market's still cheap. Bonds are giving you incredible yields. The local market's still cheap from a valuation perspective. Would I be fully invested now, specifically after this run we've seen? Probably not. I'd maybe leave a little bit of powder dry. Like I said, there's still a lot of water to flow under the bridge. I mean, you've got US CPI numbers, you've got the Fed speaking in a couple of weeks' time. There's still a lot that needs to go on for me to get completely excited. But at the same time, I still think there is opportunity there. So be invested, but also be a little bit cautious and leave a little bit of cash on the table in case it's a bit of a pullback.
Are you doing the same thing with the US side of things, given the fact that the Fed still needs to get to restrictive territory?
I think so. And again, similarly to what I've just said about the local market, we've had a very big run offshore. And I think people are getting a little too excited now. And I think there's still, like I said, a few things that need to play out. We still got another CPI number. We still got the Fed meeting in the middle of this month. We still got a war in Russia and Ukraine, although things look to be going in a positive direction there. So, and we have a potential recession coming on board from kind of next year in the US. So still some things to play out. Keep investing, keep being flexible and getting into companies that you want to hold for 2, 3, 4, 5 years and looking for opportunities. But again, I wouldn't be going full out at this moment in time. Before
I let you go, going into 2023, we spoke about the possibility of a recession. Is there another risk that you're seeing?
I hope not. I think we've used all of our risks and everything's come through in 2022 so far. So hopefully nothing more. I think the biggest thing is recessionary talks. Like I said, Russia, Ukraine seems to be abating somewhat. The Chinese reopening story seems to be coming to the fore, and inflation seems to be kind of tailing off in the States. So hopefully we're looking for a kind of clean cut to 2023. But I think, like you mentioned, the biggest thing is probably recession.
All right, Martin, thank you so much for your time. That is Martin Smith, who's a portfolio manager at Anchor Capital, giving us his perspective on the markets and hopefully crossing fingers that next year, less risks. We probably will be dealing with the possibility of a recession. We'll see how that plans out. All of that is data-driven, as a lot of the central bank heads have been saying. But that is it in terms of the market's perspective. We're going to take a quick break and we'll have more news for you, so stay tuned for that.